So this morning we'll start by revisiting some of the changes to corporation tax and how they could impact your business. Next, we'll look at the interaction of the recent interest rate rises with tax. And finally, we'll touch on some developments in the international space. So on to the first part, corporation tax changes. So most people will be aware that the rate of corporation tax is now 25% for most companies, i.e. those with taxable profits in excess of 250K. And those with taxable profits of 50,000 still remain taxed at the older rate of 19%, with an effective tax rate of 26.5% for companies that have taxable profits between 50,000 and 250,000. There is a reintroduction of the associated company rules, which we had previously in 2015, which is the last time we had a non-unitary rate of corporation tax. And broadly, associated company rules are where one has control of the other, so one company has control of the other company, or both are under the control of the same person or persons, and they include worldwide companies. Now, the reason that the associated company rules are important, as it says there, is they are used to reduce the thresholds for quarterly payments, which is 1.5 million and 20 million for quips and super quips respectively. So quarterly installment payments and super quarterly installment payments, where payments are accelerated by 4 months. In addition to the corporation tax rate change, full expensing, which allows up to 100% tax relief on CapEx, was made previously. It previously had a sunset date of March 2026. And this is unlimited and applies to brand new plant and machinery used in a trade, giving relief of 25p for every pound spent. So how do these changes impact your business, and what are some planning points to think of? So the introduction of the associated company rules, as I previously mentioned, means in some cases the normal thresholds are reduced considerably, accelerating tax payments to HMRC and therefore the cash flow burden to businesses. An extreme example is recently where we had where we were acting for a 3 UK company group owned by a non-resident, non-dom individual. The companies made modest profits, so paid some tax in the UK, but after the normal sort of 9 months after the year-end time period for payment. It transpired upon further investigation that the same individual also owned another 35 companies overseas and worldwide. So the UK company group was immediately into super quips, so that all tax liabilities were to be settled before the year-end to which the liability relates. So this means it's worth revisiting how your business affairs are structured, and it could be to minimize the number of active companies held by the same person or persons or corporate group, to reduce the number of associated companies and therefore stop falling into quips or super quips due to thresholds being breached. Alternatively, it might be to bring a loss-making company or group of companies into a profit-making group to access losses and reduce overall liabilities. In terms of full expensing, that can be useful for businesses which are capital intensive, but in most cases, it's a much more significant consideration will be the impact of inflation and higher costs of financing, eroding a lot of the tax benefit and incentive. Furthermore, as the full expensing operates alongside the annual investment allowance, or AIA, with its £1 million limit, full expensing is likely to be far less useful for most businesses that never hit that level of spending, especially as AIA is usually far less restrictive and provides more relief generally. So moving on to the impact of interest rates in the tax landscape. So as you know, interest rates have been rising, although stabilized more recently, and within HMRC interest rates directly linked to the Bank of England base rate, potential late payments of tax now attract a significant penalty in real cash terms. Alongside the increase in the corporation tax rate and the associated company rules I mentioned just now, this results in paying more tax earlier with a potentially higher penalty for non-payment. One interesting aspect of this is that credit interest rates, so where companies or businesses have made overpayments of tax, the repayment or the supplementary interest on that is now increased. It's currently at around 3.5% or so, but that's still significantly below the penalty rate for late payment of interest. Another consideration is the UK's corporate interest restriction regime, or CIR. This broadly limits the amount of tax relief you can get for deducting interest and other financing costs in the UK, either in individual companies or groups of companies. Although a very complex set of calculations and workings are used to determine the actual restriction, there is broadly a de minimis amount, which is 12 million for a 12-month period and one group of companies. But with the increase in the interest rates, this limit could potentially be breached quicker, and therefore additional work would need to be done to check if the restriction applies and to what extent. This not only results in additional administrative costs in terms of doing the calculation and making sure any restrictions are not breached, but also if the interest deduction is restricted, then it will accelerate tax payments where the interest deduction is not allowed or it's deferred to a later period. So moving on to the international aspects. Recently there was the base erosion profit shifting pillar 2, so BEPS pillar 2, which introduces a minimum 15% rate of tax for international groups. Now, international groups as defined are those with annual global revenue greater than 750 million euros. And the minimum tax rate is effectively to be policed by way of two pieces of domestic legislation in the UK, working in tandem but with different targets. So multinational top-up tax will impose an additional top-up tax on UK parents who have interests in entities in territories with effective tax rates lower than 15%. And this will bring the overall effective tax rate of the group to the target 15%. Conversely, domestic top-up tax will impose an additional top-up tax on UK companies to ensure that the effective tax rate in the UK is 15%. So the two effectively work in tandem, albeit at the opposite ends of the spectrum, to ensure that the UK doesn't, there is no tax leakage from the UK, where the effective tax rate is 15%, so that other territories where the rules are in place do not obtain what will be seen as the tax benefit of these rules. The rules are in effect for accounting periods after the 31st of December 23. So those with operations in multiple jurisdictions, and particularly those where the local tax rates can be lower than the effective 15%, should just be cautious. So to summarize, we've effectively got the triple whammy of a higher corporation tax rate, effectively up to 26.5%, albeit it's usually 25% for most companies, payments being due earlier under the associated company rules, and late payments incurring higher rates of interest. This has a knock-on effect for businesses, putting significant pressure, not just from a cash flow perspective, but also administratively. And finally, those businesses with international operations should also be mindful of the effects of the top-up tax legislation, not just for the UK, but also worldwide, as these rules will be replicated in a number of countries.